Howdy, Jacob here. Today we're looking at Microchip Technologies in the semiconductor and equipment industry. 48 billion market cap, 52 billion enterprise value. Very large company. Recently, great returns on invested capital, but historically, more recently, not quite as impressive in the mid single digits. Their balance sheet shows a little bit of cash on hand with quite a bit of debt. So 6.4 billion in debt on 234 million in cash. That's 6.4 billion compared to their 5-year average free cash flow of, let's say, 2 billion is unsubstantial, just about 3 years of their 5-year average free cash flow. So I don't think that I'd have a concern with their debt situation. They have been paying down a lot of debt after they made this acquisition in 2019, so it does look like they're a company that's going to pay down that debt and have it not be a big burden on them. So I wouldn't be concerned with the debt. As for use of free cash flow, quite a bit of reinvesting back in themselves. We can see that their capital expenditures have grown pretty substantially over the last 10 years. They also repurchase a bit of debt. They pay a little bit of dividend. That dividend is going to be about 40% of their 5-year average free cash flow, and repurchasing shares, repurchasing a fairly significant amount of shares. Hopefully, they're buying that back at cheap prices. And yeah, it's use of cash. I think we're ready to start making some assumptions here. Fantastic growth, as we can see, 1.9 billion in 2014 to 8.4 billion in 2023. So the growth is absolutely there in the semiconductor industry, where there is a bit of competition, but the entire market is expected to grow at double digits CAGR. So very impressive growth for their industry as well. Let's say that they can grow 8% a year and then 17 on the P price to free cash flow, just due to the fact that their return on invested capital hasn't been absolutely substantial. Outside of rolling 12, we're looking at mid single digits. So I don't think that the reinvestment is that impressive, at least historically. I do absolutely love free cash flow is absolutely gushing. That is a positive sign. Um, so I'll probably bump up their earnings a bit closer to their free cash flow margin. So let's maybe do 25, 30 share change, a buyback. Oh, that's too much. 0.5%. They're going to be buying back 240 mil. Okay, maybe let's do 1%. So they buy back about 480 million in aggregate, roughly. I think that's more reasonable. And their dividend, they've increased it heavily in the last 2 years, not so much before. So let's say that they just grow it a little bit here. They use that other cash to just really push reinvesting back in themselves to get this growth rate that we're looking for. And we get a price that just needs to fall 37% before you get a 15% return. That sounds pretty substantial, but it's honestly would not be surprised if fluctuations of a singular stock in a year are well over 37%. So it's really not that great of a fall to get to. So I wouldn't be surprised if I'd be doing more research on this if it got within 10% in not too long of a period. So decent company. Earnings margin being so different from cash flow looks a little bit weird. I know the last 2 years looks a bit closer, which is nice, but so different is weird. I do like that free cash flow is higher though. Return on invested capital hasn't historically been great, but if they're really willing to find those opportunities, those rare opportunities to get massive returns, I think that you're going to find that could be times of the past and they'll be improved. But for right now, it's just a little bit expensive for me, and I'll wait to do more research on it. Hopefully, you enjoy the video and have a great rest of your day. Thank you.